Change. It is a constant. It surrounds us. We have all experienced it and lived through it. We have all been transformed by it. It is imprinted in the seasonal changes of nature, bringing us abundance. And it is part of everything around us and within us. An intricate part of your life and ours. It happens at its own pace, with unique complexities, like a symphonic rhythm of the stars across the African sky. A renewed shift in energy, an evolving reality moving us forward. As Capricorn, we have embraced change along our journey, leading us to our significant achievements in the last 4 decades, urging us to grow our footprint across the Tropic of Capricorn, from Namibia to Botswana. Our purpose of improving lives through leadership and financial services by being connectors of positive change is our North Star. Every Capricorn member strives for it today and tomorrow. Change is inevitable. It transforms us, but it does not have to be negative. Like us, you are the creator of your journey and the author of your unique story. Your journey inspires us, and we are invested in your success. Let us journey together and make change positive as one. Capricorn Group.
Good morning and welcome to Capricorn Group's annual results announcement presentation and integrated report launch. My name is Festus Nagatana. I'm the Corporate Affairs Manager at Capricorn Group. And before we start with the core business of this morning, let me first acknowledge and introduce to you our panel of speakers. On my immediate left is our Group CEO, Tinus Prinsloo, followed by Baroness Hans, Bengwenduk Managing Director. And then we have Johan Mas, Capricorn Group Chief Financial Officer. And then last but not least, Thenaune Kamberipa. He is the Chief Financial Officer of Bengwenduk. Ladies and gentlemen, thank you for joining us this morning here at Capricorn Corner and also online via Facebook and YouTube to hear more about our group's performance and highlights of the past financial year. Tinus and Johan will start off with highlights of the group's integrated annual report, and then Baroness and Thenaune will shed more details on the performance of Bengwenduk. As you know, Bengwenduk is our flagship brand and the main contributor to the group's profit after tax. Following the presentations, I will allow an opportunity for questions and answers. So you're welcome to note any questions as they do their presentations. So I'll now hand over to the panel. Tinus.
Thank you, Festus. And good morning, everyone. It's a great pleasure to be here today. And I see on the screen it talks about the annual results presentation. But I think the more important part that follows after this is also the launch of the integrated report. And I think to a large degree that is the message that we want to convey. It's around how the group is integrated, diversified, and is delivering results and outcomes for all our stakeholders. It's not just around the shareholders. I think building on to what I've just said, in terms of the integrated report, our focus areas are really in 6 domains. The 2 most important ones that stand out for us is the customer and how we continuously try and strive to build a better experience for the customer. No matter which entry point into the group they take or at which company, we strive to make it easier for our customers to do business with us. And that is using various tools and techniques, but at the moment we're specifically focusing around leveraging data and leveraging digital channels and capabilities to make that experience far better for all our customers, no matter where they come in or what their need is. In terms of financial services, we strive to provide the best experience through our relationships with our customers. Through that, we also try to achieve the shareholder outcome of a lower cost to serve. And I think some of that is reflected in our results today. where we are trying to improve the leverage of the capital available to us. And that continues to give us a scalable and competitive advantage. I think the second focus area for us is around our employees also. It is the success of any company is down to good leadership. So it's about that handshake between the company and the employees to achieve the superior performance. And I think within that, it's also a big thank you to all our employees for their contribution during this year. We really try to strive to create an environment where everyone feels they belong, no matter their background or history. The third aspect that I want to highlight is our focus around sustainability, where we actively look at all the aspects around the society, governance, environment, and focusing more and more, probably with a lot of the other companies in the world, looking at ESG. And we've actively focused around sustainability with the appointment of a group head of sustainability, a sustainability program that's integrated across, looking at all the aspects of ESG. And over time, we want to ensure that we contribute to society as much as we service the customers and deliver for the stakeholders and shareholders beyond that. So with that, the other two choices that we focused on in the year is to grow with an entrepreneurial action. And we have successfully launched a term lender in Botswana as the key action over this last year. And that is starting to develop very well. And then on the people side, we've prioritized diversity, equity, and inclusivity to really focus on race and gender and represent the demographics of our chosen markets. And with that, we've also appointed a Botswana MD in Botswana this year, Olubili Makupa, who for the first time will then lead with the local market perspective also there. So we're looking forward to the growth in Botswana especially. So I think that at the high level, the strategy and the choices, there's a lot more covered in the integrated report, and I'd like to urge everyone to really go and look at that, where there's probably most of your questions answered. So I think with that, I'd like to hand over to you, An.
Good morning. It's my extreme pleasure to present the financial results of Capricorn Group for you today. I think it's a very good set of results, as you would have seen when it became public yesterday. But it's not only a good set of results for the group and for the shareholders, but I think all of our stakeholders, starting with the staff members, the government, and our suppliers and our customers as well. But more on that a little bit later. I think I would like to delve in just to set the tone as to what happened from a macro perspective over the last financial year. It was a year that was plagued specifically by low private sector credit extension. In Namibia, we only had 3% growth in the country. That being said, the group was able to grow loans and advances by 5.2%, but with a big chunk of that actually coming from our Botswana companies, with Bank Gaborone having in excess of 10% growth, and also the introduction of Payo Finance, who grew their loan book almost from a zero base up to just shy of 400 million pula for the year, while Entrepo also managed to grow their loan book by 10% over the last year. Then I think the big thing that we sort of forgot, because inflation is under control currently, but during the financial year, the whole region experienced significant inflation rates, and none more so than the 14.6% high that we saw in Botswana during August 2022. Now, the central bank in Botswana took a different approach to the rest of the world. They only increased their bank rate by 50 basis points during the financial year, which is very different to what the rest of the world did. My belief is that they saw it as because of the inflation coming from fuel prices, that it's imported inflation and that the interest rate adjustments would not have made a big difference to it. I think to a large extent they have proven themselves correct, because without that the inflation rate still came down to 4.6% as at June 2023, and it even came further down afterwards, with them recording an inflation of 1.5% during July 2023. In Namibia, and we saw a 300 basis points increase in the repo rate for the financial year, as the central bank used that as a lever to try and control inflation. But it was still 50 basis points less than what our neighbors to the south did, where they increased their repo rate by 350 basis points. And it is pleasing to see that we haven't experienced that capital flight to them that we normally see when our rates are lower. So I think that does mean that the international investors are really seeing a good potential future for Namibia. Now, with these interest rate increases, obviously it does benefit the bank when the rates are higher, but we need to take into account that from a funding point of view, these rates also go up quite significantly when we do see these rate hikes, especially from a Bank Windhoek perspective, where a large chunk of the book is in stable funding in order for us to maintain our liquidity levels. But I think the Treasury teams really did a very good job in protecting those margins when we saw the increases. The other downside when interest rate goes up so significantly is on the credit side, where customers will start to default because of affordability problems. But I would like to quote Sirius Capital when they put out their view on Capricorn Group last night, where they made mention that the Capricorn Group is the only banking group where the loan loss ratio went down year on year when compared to our competitors on the last set of financial results. So I think all credit to the credit teams, both in Namibia and Botswana, for actually having a lower impairment charge in the financial year. Now, if I can move over to the key highlights. So yeah, I think the big news is 28.7% increase in our profit after tax to 1.47 billion, which is the highest profit that we have recorded to date, which then translated into an ROE of 17.6%, also the highest that we've had since 2017, and significantly higher than the low of 12.6% that we have experienced during the COVID-impacted 2020 financial year. Then I think very proud that our dividend per share has hit triple digits for the first time, so it's now 100 cents. Up from 72 cents in the prior year. Now, bearing in mind that we did declare a dividend of 39 cents during February, meaning that the final dividend that will be paid is going to be 61 cents. Now, I am guessing that the majority of the people in the room are indeed shareholders, so you will be benefiting from that dividend payment. If you're not a shareholder yet, you have until the 29th of September to buy your shares. That is the last date to trade Kumdiv. So if you would like to benefit in this dividend, make sure that you buy your shares before the 29th of September. Earnings per share, headline earnings per share also up by 31 and 38% respectively. The big difference of 8 cents in the earnings per share that is noted is mainly coming from our dilution in the Paratus investment, but I will speak to that just a little bit later. But I think with all of this, a good set of results, we still have the highest CAR ratio that we had since at least for the last 5 years, getting to a 16.9% as at 30 June. Then just to quickly highlight where our profits are coming from. So still the majority of our profits, about 93%, is concentrated within Namibia, with our flagship bank Windhoek contributing 76%. Now it should be noted that back in 2021, as is evident on the screen there, Bank Windhoek's contribution was only 59%, which does show the impact that COVID had on the bank specifically. And I think during that COVID impacted period, our diversity in the group actually helped us to not fall as far as our counterparts did that only had banking subsidiaries in their group. And then again, obviously, you then benefit from that when the growth starts coming through, which we saw in 2022 and 2021 post-recovery from COVID. Then I think we've now officially moved past the recovery phase, and we're now fully back into the growth phase again that we saw back 2018, 2019 prior to COVID. Just looking at the 2021 numbers, I think most of the times when people think about COVID, they think about 2020, but we need to remember from a financial year perspective, that financial year ended 30 June 2021 still has a big COVID chunk in there. Excuse me, a large majority of the financial year was still impacted by lockdowns, curfews, and all of those restrictions that I think we have forgotten by now. Be it as may, in 2022, you'll notice that every single number on the screen is better than the 2021 period, which then shows that recovery post-COVID. And then again, when you look at the 2023 column, every single number there is better than the 2022 column, showing that that movement back into the growth, which I hope we can continue on going forward. Now, I did mention the Paratus dilution, and I think it is just important to highlight this because it is a bittersweet dilution that we have experienced. Now, the background to this is back in 2019, when we acquired a 30% stake in Paratus, we included a clause in the sale of shares contract to say that should Paratus not meet their business case, some of the shareholding of the founding shareholders will come towards Capricorn Group on a sliding scale from 30% up to a maximum of 36%. However, the inverse is also true, that should Paratus exceed their business case, that Capricorn Group will then dilute on a sliding scale up to a minimum of 26%. And I'm glad to report that Paratus far exceeded their business case, meaning that Capricorn Group had to dilute and give away 4% of our investment to the founding Paratus shareholders. That then led to a loss of 38.2 million in the financial year, basically giving up the cost of that 4% investment. But it should be noted, as I mentioned, it's because of that far exceeding their business case, meaning that there is actually a big fair value growth in the Paratus investment, which we haven't booked yet because we can't book it based on the requirements of the accounting standards. So to put that into context, 30% of our investment in Paratus was worth about 232 million NAD back in 2019. Even after the dilution, our 26% investment in Paratus is now valued at approximately 400 million NAD. So definitely a big growth there. So as I said bittersweet that I had to book a loss of 38.2 million, but definitely I think good growth from Paratus and good growth that we still expect from them in the future. Now, as I mentioned at the start, it's not just about the good financial results, but it's also about the part that Capricorn Group plays as a responsible corporate citizen in the country and in the region where we are. So Capricorn Group created value of about 4.4 billion NAD in the current financial year. That's an increase of 725 million over the last year. And that is then shared by our stakeholders. So our staff members shared in about 1.2 billion worth of that in the form of salaries and other forms of compensation, for example, contribution to the medical aid pension funds and so forth. And we all know how the setup in Namibia is, where one staff member will actually take care of a whole family. There's a spouse, there's kids, and in most instances also an extended family as well. So it's not just about supporting the staff members, but it's also about supporting their families as well. Similar with our suppliers that benefited. Now, of the 812 million that was paid to suppliers, I'm proud to report that 560 million of that was paid to local businesses. So that's local suppliers inside the countries where we are. Now, we would have loved, as a responsible corporate citizen, to have that as close to 100% as possible. Unfortunately, being a bank, there is a big reliance on software and IT and other technology type of expenses. The large majority of which isn't available locally, and unfortunately we have to go and source that from a foreign perspective. For the first time ever, we've then also contributed $1 billion to the government's coffers. That's now in the form of direct and indirect taxes, meaning that it includes our current tax that we paid together with VAT and then also pay as you earn, and then other stamp duties and levies. We've specifically included the pay-as-you-earn here as part of taxes and not as part of the staff contribution, because even though the money is technically a staff expense, the staff member didn't benefit from it. The government actually benefits from that pay-as-you-earn. And we're proud to report that total has gotten to $1 billion in the current financial year. We also then spent 21.7 million in community services projects during the year. And that will benefit, obviously, the most vulnerable in our communities. We have launched our social value report last week, Thursday, and that is available on the website. So if you would like more information on that 21.7 million, there's a lot of detail in that social value report. Then, yes, the shareholders also benefit from this profit, total of 408 million that was paid in dividends during the current financial year. This excludes the 316.4 million of final dividend that we'll be paying next month on the 20th. And as I mentioned, you have until the 29th of September to go and buy your shares. And then, obviously, we can't pay out everything. Some of it has to be maintained in the group in order to fund our future growth. So that's $1 billion that we have actually kept inside the group. That is now to fund future loans, to fund your dream house, your dream car, or your business. And then also keeping it in order to improve our branches and our service delivery as well. Now, there's one important stakeholder that isn't mentioned on the screen, and that is the customer. But I'm going to hand over to my colleagues at Bank Windhoek, Berenice, because they're going to speak a bit more to the value that was added to the customer.
Thank you.
Thank you.
Good morning, everyone, and thank you so much for joining us this morning. We will also just continue on the macro context, given that we're a small open economy. the global, regional, and national context really affects the way we do business and affects the outcomes of our business. So just focusing a little bit on the global context, what we are seeing is a continuous geopolitical divide. We are seeing across the globe, across the region, and also in our own country, monetary policy tightening on the back of persistent inflation, and that is experienced with its pros and cons across the world. Now, if one looks at especially the global context, we continue to see a more modest outlook, especially if compared to historical norms. We're also seeing that advanced economies are showing more of a slowdown when compared to your emerging markets typically. And the overall risk balance for global growth is skewed towards the downside. Regionally, I won't go into too much detail. Johan's touched on some of it. But I think the thing that does stand out is the instability in West Africa that we've seen with the recent coups, but also the South African load shedding process, which is moderated but remains a concern for the region. In terms of our country, I'll just focus on two items, really, the weaker rand and its impact on more expensive imports, and also the cost of borrowing and its impact on the fiscus as well as on the consumer. We also expect the re-emergence of El Nino, and we expect some strain on our crop and livestock farming. But if I can move into the more exciting part of our business, which is really our strategy. I think Tinus and both Johan mentioned that we've concluded our 3-year strategy, which ended on the 30th of June 2023. We started this cycle on the 1st of July 2020, right in the middle of the pandemic. And it was a very difficult time to plan because during the COVID period, it was very difficult to think forward, to think about a future and to plan. It was also very difficult not to be distracted. So we were very deliberate in charting a path forward. We were very deliberate in building a future that was, or planning at least at that point, a future that would be better than our past. And on that note, these were the choices we made. So our first strategic choice during the past 3-year cycle was growth. Growth was very difficult to motivate when everything was shutting down. But we needed to remain focused, as I said earlier, and we needed to think about the future and position ourselves for that future. The other choice we had was distribution, the choice we made, rather, was distribution. Distribution really in terms of customer channels, in how we engage our clients and how we use technology to better engage our clients. And then the last two choices were really around our people. We are in the business of people. And making sure that that we invest in our people in terms of being future fit, acquiring the right skills, was very important for us and is very important for us. And also making sure that we embrace diversity, equity, and inclusion as a strategic choice. Now, all of this is built on a foundation of what we call our business fundamentals. And this is really managing your risk, your credit risk, your liquidity risk, your capital risk, cyber risk, but also our social purpose, which is really our purpose beyond profit, which we'll also talk to a little bit more later. If I can go to my next slide, really our success is heavily dependent on the success of our customers. So over the past financial year, we just like to reflect on some of the things that we've done to enable customer success. On the back of the rising interest rates, yes, there's a lot of downside in terms of the cost of borrowing, but there's also a lot of upside when it comes to savings and investment. And over the past year, we were able to pay about 2 billion to depositors in terms of the investments they made with Bank Windhoek. We've also been able to process cash to the tune of 14.3 billion and transaction volumes related to cash of about 6.7 million. We're able to give new homes to our clients to the tune of almost 3 billion at 2.9 billion. And also, one of the key concerns in our economy, and we often hear about it, is the support for SMEs. And we've really tried to position ourselves to help our SME clients over the past year. We focused on I don't know if you must all be aware of the government loan recovery scheme, which is where all banks participate. And this was done in partnership with the Ministry of Finance as well as the central bank. And under the scheme, we were able to help our clients to the tune of 100 million, but we also went back for more, and we expect to disburse at least 200 million before the end of this first quarter of our new financial year. But we didn't only support our SMEs through the government recovery scheme, we also supported them through our own initiatives, and that was to the tune of 1.5 billion. We've seen our customers respond very positively to all the investments and innovations we've made, and I'll talk to that in the next few slides. But across all our key segments, we've seen more than 20% growth in our number of customers. In terms of loans disbursed, we disbursed about 7.9 billion before, this is before runoff, to customers in new loans. And also, really, our online channels are starting to take off and starting to become center stage in terms of how clients do business. On those platforms, we were able to process 26.6 billion in value of transactions. Now, we did all this without taking undue risk. And this is evident if you look at our key credit indicators. Our loss ratios are down, our non-performing loans are down. So we were able to position ourselves well. And as I said, we started out in the pandemic. And it was very important for us to do business, to continue to grow, but also to do it responsibly. As our founding shareholder, Mr. Brandt, likes to say, there's always opportunity, you just have to look for it. And that was very much evident under the way we had to do business in this cycle. If I go to our next few slides, we'll be talking about our distribution choice, which really is about evolving our customer touch points. It's about making sure that at every touch point, clients have a great experience. And it required a lot of investment. And again, looking at where we started in 2020, it was not really the right climate for investing if one looks at where the world was at. If we looked at the devastating consequences of what we were facing back then, it was not an easy decision to invest, but it was the right thing to do. So we invested extensively in our network, in our footprint, and we've also introduced on the back of that 45 new cash accepting devices across the country. These devices enable clients to deposit, but they're also recyclers, so you can deposit and withdraw. We also rebuilt our mobile app from scratch. We looked at the mobile app in terms of services that we wanted to migrate to the mobile app, and we've enhanced it substantially over the past 3 years. I'll just touch on the branch. We looked at the migration of services, and this was a core theme for us, the migration of non-essential financial transactions away from the branch, and how we repurpose the branch, which I'll talk to briefly in the next slide. So if we go to the next slide, our customers responded very well to the investments that we made in technology. If you look at our ATMs, and I'm talking here about especially the note-accepting ATMs, we saw almost 200% increase in volumes and in value over the past financial year. Our Easy Wallet continues to outperform, and we've seen a 36% uptick in the use of Easy Wallet, both in terms of users, volumes up 30% and value up 26%. Cell phone banking we thought was going to die down, but it still remains very popular in the north. And when we talk about cell phone banking, we're talking about USSD, your typical dial *150 type banking. But that's also continued to do well. Across our merchants and our point of sale activity has picked up, and we're seeing good growth there. But our mobile app has really stood out. If we look at the number of users, they've increased by 47.8%. Our volumes are up 77%, and value is up 66.7%. If we just look at the value processed through something like our Easy Wallet, we were able to process value of 4.5 billion just through that channel. Now, the mobile app is very critical to us because it becomes your primary bank, especially for your personal market segments. So what we're trying to position with our strategy is how does your mobile app become your first point of call in terms of convenient banking? But it's important that we marry this with a great branch experience. So when we looked at our channel strategy, it was very much around, yes, technology, yes, digital transformation, but also how we transform our physical branches into complementary channels that extend the value created by our digital channels. So we've repurposed our branch. We've just shared them with the photos of our Marua Mall branch. We've repurposed the branch as a place where relationships happen. It's very important for us that our space, our people, and our technology in the branch are also future fit. That our branches are also digital, but that when you come to the branch, you're not coming to do something that you could have done conveniently at home. When you come to our branch, you're coming to have a higher value interaction with us, such as a complex business loan. So the branch is a space where we want to nurture your dream, where we want to talk to your more complex needs, and we want to engage you personally to talk about your plans and your priorities. And that's been important for us, and that's really the essence of our digital strategy, was migrating those things out of the branch that would typically not be the right thing for a client from a convenience perspective to do in a branch. Some of the examples I'll mention are bank confirmation letters. There's no need anymore to go to a branch to get a bank confirmation letter. You can get it on the mobile app, and you can get it on our new SSK devices at our branches. So we've launched 3 of these new concept branches. They are smaller, they are different, but they are really meant to enhance the experience. And it comes together for us in these 3 things, that we want great places, great spaces, great technology, and great people. And the combination of those 3 are really what define the competitive advantage that we want to build. If I can then move on to the things that really underpinned what we achieved, as I mentioned before, diversity as a competitive advantage, growing leaders. Everything stands and falls by leadership, and we firmly believe that. And over the last year, we've substantially invested, actually not last year, the last 3 years, in leadership training, in upskilling, and in attracting and retaining future fit skills. Of late, we've appointed a data scientist who's really helping us just to craft our data, as Tina said, our data and digital strategy to the next level. But as I said earlier, our people are the real difference makers. And we've had a very engaged team based on all our engagement scores. We're very proud of the people we have working for Bank Windhoek and for the Capricorn Group. But it's also been underpinned by a very strong balance sheet and also risk management practices. We've seen, as Johannes said earlier, our improving ROE, which really talks to efficient allocation of capital and better use of capital. But lastly, it's also been important for us to organically create capital. If we look at the rest of our business, and I think Tina's also touched on this earlier, it's really sustainability, embedding sustainability in how we do business, but also you can also see sustainability as a business advantage, and that's what we've been trying to drive with our customer loans that we've introduced recently, our sustainability customer loans. So it is important for us to transition to green, but it's also important for our customers. And when we started this journey, we launched our first green bond, I think was in 2017. And since then, it's really been a journey of innovation, of finding new ways, of adding real tangible value, not only to ourselves, but to our customers in terms of sustainability. It's also been, we love renewable energy. We're very focused on it. And we see Namibia as having a natural advantage when it comes to sustainability loans and sustainability finance, especially when we look at our solar plants, of late, the green hydrogen. So there's a lot of opportunity, and I think we're very well positioned to take this opportunity as Namibians and to make it work for us. In terms of local spend, Johan has mentioned how we've spent and how we've prioritized local spend. And we've been making sure that our local suppliers are involved and are getting a share of the cake in terms of procurement spend. And lastly, we still remain very invested in education and have been a key sponsor of the NTA in terms of various educational training, awareness, and seminars that they've been hosting. And I think in the earlier slides presented, we spoke about turning 40. We turned 40 last year, and our theme was really about giving back. How do we give back? And our biggest vehicle for giving back has been the Capricorn Foundation. And we're proud to say that Bank Windhoek is the largest funder of the Capricorn Foundation. We were able to channel 9 million to CSR activities as part of a combination of the foundation, as well as our own CSI committee back into Namibian communities. We were able to also continue with our flagship program, the Cancer Apple Project. Thank you all for supporting this project. We are busy selling apples right now, Jackie, so please support. Through our initiatives, we were able to raise, I think, up to last year, about 33 million to prevent and to create more awareness around cancer. But just in a nutshell, I won't go into every single point here. We've also supported drought relief. We see ourselves as being very dependent on Namibia, and we are very thankful to Namibians because we are built. Bank Windhoek is 100% Namibian. We are supported by Namibian communities, and it's very important for us that we thank those Namibian communities for the bank that we were able to build over the last 40 years. We want to thank all of you for touching our bank in one or other way and contributing to the success of Bank Windhoek. But before we get into the numbers, I'll be handing over to Mr. Kamberipas, just the point that financials are an outcome of everything that we do. So for us, it's very important that the inputs into our strategy and the focus gives us the results. And we can really say that given the review of our last 3 years strategy, we were able to say with confidence that the things we invested in created the activity and the customer growth that gave us these results. Thank you very much.
Thanks, Baroness, for that. It's interesting that you call me Mr. Kamberipa today, but I'll take it from there. So I'll cover the financial results, everyone. And I think both Baroness and Johan spoke a lot to the macros, both from a global, regional, and Namibian perspective. But what I will try to do is actually link this to how our results play out. So GDP growth at circa 3%. A lot of that comes from mining and quarrying activities. So what you then see is that then the other sectors have sort of grown, but not to the same extent. And one can see those vulnerabilities sort of in our results. So one side you'll see growth, but one side then you'll see the challenges we are facing. Private sector credit extension, which Johan spoke to as well. And that what you see, the 3-4%, a lot of that is driven by individual credit, and there's been very little growth in business or commercial credit. Of course, our business balance sheet is tilted towards corporate and commercial, so then you'll see that our growth in advances is not as good as it could have been. On the repo rate, up 300 basis points year on year, so average 160 basis points. Of course, this plays into how our margin moved year on year, but then you will see the other side is how we have tried to tilt our balance sheet towards cheaper funding, but that I'll cover in more detail later. On highlights, so I think Baroness spoke a lot to this, is that interest rates, yes, have had a big impact on profit growth. Year on year profit up 34% for Bank Windhoek. But that's just one side of the story. I think our continuous investment, our continuous focus on our strategy has really also contributed to this. And we are comfortable because I think focusing on those fundamentals, as Baroness said, customer growth, customer activity, will also stand us in good stead for the future. Then profit growth, then ROE of 17.2%, above our cost of capital for the first time since 2019. And then cost to income at 48.3%. Of course, a lot of that is due to income growth, but then also speaks to our focus on efficiency. Because I think a cost to income ratio of below 50% for a bank, I think, is very good, or a universal bank. Of course, there are other examples in the world that are very low and others the other side, but I think 50 can be a good yardstick. And when we look at risk, capital adequacy at 17.2%, well above the regulatory minimum end state of 12.5, but I'll also give a bit more flavor to that later on how we got there. And NPL ratio at 5%, down year on year. There's a lot of focus on credit, business rescue, pre-legal, and that really plays out in our NPL as behaved. Liquid coverage ratio, net stable funding ratio, all above 100%. So obviously this is not yet, the regulations, Basel III is not yet implemented, but this is something we've been tracking for the past how many years now, just to ensure that when it does come live early next year, we are ready for it, and I think we are ready for that. On the next slide, I'll try to give a bit more flavor now to advances, growth, and PSC. So on the right side, you see that our advances growth the last 3 years was always above private sector credit extension. As Baroness alluded to, did you say Mr. Brand always says you must find opportunity? Huh? Yeah, and I think our origination strategy for me, since I've been here and I've seen it, is always been around our deep understanding of our clients and our deep understanding of our markets. Even in COVID, when some competitors were shying away from giving credit, we still found opportunity, and we built that quality loan book that then translates into our interest income now has played out in this year. This year, you will see that some competitors have tried to come back to the market, but we continue to grow. It's just that there's very little demand from corporates and commercial, and because we are tilted, like I said earlier, towards that part, our growth in advances, one could say, is somewhat muted. But we'll continue to look for those opportunities going forward. On this side, you'll see a lot of our growth came from. Am I having a teenage moment now also? Yeah. Residential mortgages up 4.2%, something we are proud of. We do know that probably for most of us, mortgages will be our biggest purchase in our life. We will continue to support that. We'll continue to look for the opportunities for that. We do know housing is a challenge in the country, so we do fund where opportunities are. And then the other product that we grew the most was vehicle and asset finance. If you look at this product, I think 5 years ago, 2018, somewhere there, we were probably third in the market, and now we're probably number one. And a lot of this has been around a focus on service, turnaround times, and in doing so, we try to become probably, can I say, top of mind to when people visit dealers, and without all managing risk. Always that angle of managing risk is there. The other products, as you can see, are more tilted towards corporate and commercials, and you can see how they were muted in the year, and therefore then that speaks to the story I just spoke to just now. On funding, I know Baroni spoke to our focus on balance sheet efficiency, and this really one can see. If you, I refer to CASA there, which is current accounts and savings. It grown substantially, and it is the biggest growth. Now it is a larger proportion of our funding is now current and savings accounts, meaning that now we are tilted towards cheaper funding. This has allowed us to let go of some of the more expensive funding, and then that almost flows into a lower than expected, a lower interest expense than we would have had. But the other thing, and my treasurer said this, is that in the second half of the year, we had unprecedented levels of liquidity in our market, something, I will quote you, Claire, is that something she said she has never seen in her career thus far. So that also plays where we were able to, our funding rates now, in some instances, are even lower than South Africa, something unusual. And so long as it stays here, then you'll keep seeing this margin shift or margin growth. So long live liquidity. Yes. On the risk side, we spoke to this, and I think it's really a story of two worlds, if one can call it that, personal and non-personal. Personal clients, of course, are feeling the strain of the interest rate hikes, and you can see that with the slight deterioration in the quality of the loan book. So my view is that I think the lag effect of the rate hikes is still coming. So this is probably still transition, and this is likely to still deteriorate somewhat further. But we continue to be on top of it, and we will manage it within the frameworks that are available to us. On the non-personal side, though, what one sees with corporate clients is that I'll use my head of credit's word here, is that they have idiosyncratic risk to it. So it's either their sector or specific circumstances in that company. And in this case, although rate hikes were up, you can see an improvement in the quality of the loan book, that works overall to a lower credit loss ratio in the year. On coverage ratio, so we continue to be adequately provided. In fact, probably you can see the increase. And I think that obviously then gives us, puts us in good stead to take, puts us in good stead to look at, say, well, when you look at what is coming, will we be able to withstand that? And my view is certainly will, because we have more than adequately provided. NPL ratio I spoke to just now, it's a big focus, and an area we have invested heavily over the last year or so around making sure we manage that loan book, and then you can see the trend coming down. So on income, so I think on the interest margin at over 5%, 59 bips higher than the last year. A lot of it coming from, of course, the rate hikes, but there's also a big component coming from the mix, as I just spoke to now. Non-interest revenue, transacting income up, I think 13% year on year. A lot of it, about half of it comes from volumes and new customers, which are fundamentals that Baroness just spoke to now. And then about, say, 6 or 5% then comes off increase in fees, which tend to be pegged to inflation, give or take. Trading income up 9%. We've seen good volumes and good margins on our forex trading, and then some of it offset by fair value movements in swaps, which have a related credit in OCI. So then you have a debit one side, and then the OCI is on as the credit. So when those instruments then mature, then that is reclassified to P&L. So we've always wanted to continue to diversify towards more NIR, or a balance between NIR and interest, as you can see on the slide. But of course, the high rate environment now has worked against us in this year. Cost is always a focus area here, up 14.39%. But what we've always said is we're not going to cut costs at the expense of the business. Baroness just spoke to now say we will continue to invest in future fit skills. So there's a headcount that came through. One of our imperatives also when we look at our strategies around, one is customer experience, two is lower cost to serve. So a lot of the investment was to take care of this customer experience part, and in so doing, set the business up for the future. The other side was, of course, exchange rate. A lot of our technology solutions licenses are foreign-based. So when the exchange rate weakened this year, that inflationary impact then plays out in the OPEX increase. But still a good story to tell, because cost to income, like I said earlier, still below 50%, which is quite good. And then my last slide, a topic I love talking about, is so ROE above cost of capital at 17.2. It's the first time we are economically profitable since 2019, as you can see on the slide on the right. And of course, on the back of all the things now that I just spoke to. On the risk side, capital at 17.2, but now a lot of this capital is actually a world of contrast, because you have high income growth with limited risk-weighted assets growth, culminating into this high CAR ratio. So if there's muted balance sheet growth and then you're still getting quite good returns on government paper, this is luckily what, when then you see you're going to see an increase in capital adequacy ratio. I think, hopefully, I don't think this is a level of where risk-free rate is so high will remain for a long time, but let's wait and see. On that note, I end my presentation.
Thank you very much, Tinus, Baroness, Johan, and then Aune. I'm sure the audience and the viewers alike online will agree with us that was quite an insightful and thorough presentation. I now open the floor for any questions or comments. Obviously, for the purpose of this platform, if you can just identify yourself and the institution that you represent. I know we also have members of the media here, so don't just ask questions, but also comment where you can.
Right, Julia from 91, and we are a happy shareholder. So congratulations on the good set of results. I have two questions. So one for outgoing CEO. So the question is on Sanlam. So there was an announcement made between Sanlam and Allianz on a JV that is going to be created for the Pan-African insurer. So long term, I know that I think Sanlam Namibia is not yet part of that initial deal, but sure, okay. So I know that Sanlam Namibia is not yet part of that initial deal, but long term, what is the impact on Sanlam Namibia, and what is the impact on the shareholding from Capricorn? So that's the first question. The second question is for the Bank Windhoek team. We are obviously all interested in what is going to happen to the endowment effect. So in the results, there's an indication that for every 100 BIP increase, there's an impact of about 100 million. So what is your views on the interest rate experience? Because obviously the opposite is true. When interest rates fall, that impact will then again impact your net interest net interest and margins. And again, what is your view on the impact on the consumer? I know you indicated that you are more corporate sort of geared, that is why your credit experience or your credit impairments were not as high. But going forward, what is because the two should sort of speak to each other. So what are your views on the interest rates going forward? Thank you.
Tinus?
Thanks, Julia. Just to check, can you hear me? The question on Sanlam and Allianz, as you rightly point out, Namibia isn't impacted by it just yet. They're busy going through the big countries one by one and getting the regulatory approval, but we're not expecting a negative impact as a result of that. I think we've got a direct shareholding in Sanlam Namibia rather than through other structures. So at this point, we're not expecting an impact. I think the change will be more at the shareholders level at the top, where there could be some shifts.
Hope I'm on. Am I on? Thank you. Yes, in terms of the interest rate outlook, it's been quite interesting. If you look at, I can tell you at every single asset and liability committee that we meet, the outlook changes because it goes from we expect the hikes to continue to actually we expect a cut in February next year. But at this point in time, we expect the high rate environment to remain on the back of just curbing inflation. But what would happen, yes, your point is correct. What happens when the cycle changes? And we've been through various cycles, and there is an impact on banks. But there are two sides to interest rates. On the one side, it's the cost of borrowing for us. And we are also, a lot of our funding is JIBAR linked. So it reprices and is quite sensitive to what happens in South Africa in that regard, as far as deposits are concerned, and senior debt in terms of bonds. So yes, there's two sides to it. So on the one side, you see the margins open up because of the advances, the impact on your loans and advances. But on the other side, what you also see is the impact on your cost of funding. And because we have quite a large stable funding base, that's very important to us. So what we were able to do in the last year is really try and reprice our funding. So a lot of the result is a combination of repricing your funding, and ZK spoke to it, really focusing on the mix of your balance sheet as far as deposits are concerned, getting in cheaper deposits and positioning for that future. But at the same time, what you also see, and I don't think this is spoken about a lot in public, is that when you have high interest rates, you tend to price at a discount. So you'll find in many instances that you start talking about prime minus rates again. So you'll see a lot of your corporate deals especially repriced to prime less one, and that becomes the norm. So there's multiple factors at play. Yes, it is something we're aware of and we plan for, And it's not just one thing, it's different things. It's a mix of your balance sheet. It's making sure we take into account a risk-weighted return on our capital and on our assets. So it is a combination, something we manage. What we've done during the COVID cycle, and that was a very low interest rate environment, was really to continue growing our base. So when rates changed and we started repricing, we departed on a very large base. So we were very intentional about looking for opportunities during COVID. We continue to grow our loans and advances, and we're talking not loans and advances in total. We're talking here, I'm also talking to specifically to customers. So when you look at bank results and you only look at loans and advances, the picture may be distorted because it includes loans to banks. But if you strip out loans to banks and you look at pure loans and advances to customers, we're very focused on growing that consistently and growing our base. I think in the last 3 years, on a net basis, probably by 3 to 4 billion, which then becomes available as additional interest income when rates go down. I don't know if my learned colleague wants to add.
No, I think Julia Baronis covered it, right? So, of course, that's why we spoke to fundamentals, to say we will continue to grow customer numbers, we will continue to, we continue to see enhanced activity, and all of that stuff, and tries to speak to diversification between NII and NIR. It is a focus we've had over the last 3 years, and we will continue to work on it. And if I look the last 2 3 years, also that increase in current and savings account can be a good shield, especially for expensive funding, a good shield against interest rates. So, and we continue to do that. Of course, it's easier said than done, as my boss always says, but we are not here to do small things. Yeah, or to do easy things.
Any more questions?
91. You mentioned the tilt to corporates. Is it perhaps not time to tilt towards the consumers? And just to build on that, how's the bank GABS tilt? Is it more corporate or more consumer? And secondly, perhaps just some progress on PEO, and has it taken some market share from the other participants? And lastly, you mentioned that on triple assets were up 10%, but the contribution is down. Can you just perhaps give some color on that? Thanks.
Okay. Can I go first?
You can go first.
Emmanuel, I'll try to cover so loan books are built over history, right? So where we are is it's almost a result of several years of business running. We are aware of the need to shift somewhat to individuals, but I don't think, but for us that play probably is more around getting that CASA. But as my boss always say, we need to first fix our ability, our cost to serve, which is all this investment in our distribution channels to be able to really go after that mass market. As for advances, I don't know whether you can really do that, because what you see is that a lot, and even if we say it's tilted, it's more, say, 55-45. It's not, say, 30-70. So I think we are sort of comfortable where we are on the advances side, but on the deposit side, my view is we will, once we are able to really embed and the ability to lower cost, to serve everyone at a lower cost to serve, we can then really go over that mass market. Baronis, maybe you can
Yeah,
add?
no, I fully agree. I think the tilt is not as big as it sounds. It's more balanced, but it has been, and it's actually been an advantage for us. It's quite balanced. We are pursuing growth in personal market segments, and in fact, when I mentioned 20% growth in key segments, those were mainly in our personal market segments. So we are growing those segments quite well. We are. So I think balance is very good, and as ZK has said, yes, it's also about the cost of acquisition. And that talks to the lower cost to serve. So how do you acquire more clients in a way that the cost of acquisition, the cost to serve, still makes sense if you look at the contribution from a particular customer segment? Okay, I'll hand over to Tinus and Johan.
Yeah. Yeah. So just on the Bank Capricorn question that you had, Emmanuel, it's still pretty much geared towards the corporate currently. But I think we just need to bear in mind that we've done significant investments over the last 2 or 3 years, specifically in Botswana, in order to cater for that personal market as well. We've launched POS there a couple of years ago. The mobile app has been launched there now. And in fact, they've now got a product called card-to-card payments, which isn't even at Bank Windhoek yet, which Bank Capricorn has now launched as well. So there's definitely a strategy and a shift to also get to those personal markets. The question on Payo Finance, it should be important to note that the 2023 financial year was actually their first full year that they had. The 2022 comparative period only had about 6 months worth of results in there. So there's a lot of upfront expenses that happened in 2022 before you've actually put some loans on the book. And then obviously, as soon as the loans start coming in, it does take a while for the income statement to grow. So yes, they have. It's still small-ish at this stage. I think it has grown quickly. So as I mentioned in my presentation, they're now just below 400 million pula in the total loan book. So they definitely came in quite quickly. But as you know, it's a big market in Botswana on the term lending side. It's still a smallish market share, but we're very cognizant that we would like to grow that book responsibly. I think if we really wanted to grow it quickly, we could have by now. We would have just pushed the funding. But it's important that we grow that book responsibly and not give out loans that we shouldn't have given out. On Entrepo, on that question that you had there, yes, so they had a good loan book growth in 2023, which is an improvement over 2022, where the loan book stayed fairly flat. However, there is some strong competition currently in that specific market, compounded then by the 300 basis point rate hike. Now, Entrepo does run a fixed rate model on the loan side, while the funding side is variable. So we did see a shrinking in their margins. And even when the rates went up, not all of those rate increases were passed on to the customer, which I think also speaks to the responsible lending strategy that we have. So that does come at the expense of margins, but I think still at 200 million PAT, still a very profitable company, and ROE about 23% for 2023. So I think it's still a good company to invest in. Tinus, I don't know if you would like to add anything.
I think that covers it. I think there's lots of growth opportunity that we're looking forward to from Botswana.
Morning, everyone. My name is Skalk from Paratus. I just got a question in terms of culture and in terms of forward strategy or future strategy. Is there any plans on crossing the border to Angola and start operations there? As you know, Paratus also has operations in Angola, and banking remains a big challenge in some of our neighboring countries like Angola. And also the second question, in terms of the current culture, I mean, what is the impact going to be with Mr. Prinsloo stepping down as the CEO at the end of this year? Are we going to expect some political interference, or will it remain, a good company as it's been over the years? Thank you.
question.
So Tinus can handle that.
Thanks, Scott. Nothing controversial in those questions. But I think hopefully the experience would have been that Capricorn Group across has been more than just one individual. We've been building a culture that was created and shaped and defined through the people within the organization, called the Capricorn Way. And I think we actually pride ourselves on how well we try to live up to that. It's tough, it's aspirational, but I think everyone contributes towards it. It's not just about one individual. We will still have to see what the future holds, and the process to find my successor is underway, so there's no preset ideas, and I think the board will also not be influenced by political interference. If we get to that point, we, as a country, will have problems, not only as a company. So I think we've got to rely on the process and also the board to make the right choices there. I'm not going to go too far into the future strategy, but I think a big part, and we probably said it about 3-4 years ago, is that one of the things and why we've embarked on the strategy around data and digital and improving the channels to the way we've done it is that historically we've been very strong on relationships. But that was a very difficult model to transition cross borders. We've known not anyone, new people to rely on. If we can do more of that through electronic channels, it will be more successful. And I think our original venture in Zambia also proved that you need to be able to transact, engage at a different level than through one-on-one engagement. It just takes too long. So we're fairly close to completing our digital channel transformation, and then we'll be able to really set up and look at how do we go into the next country. That is once we get comfortable also with the economies around us. Not all the economies are necessarily conducive for constructive banking. There's quite a number of challenges. But we'll start looking at that again now post-COVID, and once our digital channels have matured to the level where we're confident we can enter new markets with them. So hopefully that answers some of the question.
Good morning. My name is Bule from Namibia Asset Management. Fantastic results. Just something that I wanted to query. There were some terms, or not terms per se, but some signs on, you spoke about funding, Berenice. So I wanted to just delve into it, but the reason for that as well is the amount of profits you're retaining is quite big. And I know we did speak about, the future microeconomics, how's the interest rate going to play out? So we might not, I don't know if the profits will be as promising or the margins will be as promising. But my question essentially is, what's your debt to equity ratio, and what's your loan to deposit ratio looking like? And also there was a bit of talking about off-balance sheet items. Do you have any off-balance sheet committed lines that you can draw on just from a risk perspective? Yeah,
Yes.
Thanks.
I'll try and answer all of them, but I'll ask ZK to remember some of the details that you've asked. In terms of the repatriation of capital, is interesting. It's always something one has to look into, and we, as part of, I think, the larger dividend that was declared this year, it's starting to. We started embedding that in the process, but it's also important to note that if I look at Bank Windhoek, we're a Namibian bank owned by a Namibian group. So we're a little bit different in terms of how we invest, how we look at the future, and how we retain capital for investment. And our philosophy is if we can retain capital and generate a better return, we should do so. And we're still in that phase where it's important to retain capital for further growth. I'm trying to remember all the points. So the first was the repatriation of capital. Can you just remind me the other next question that you had? Fund. Okay, debt to equity, ZK can probably, it's not high. Senior debt is very low. It's tricky.
Debt to equity, I think in the bank we...
Senior debt.
Yeah.
So because our entire deposit base is debt, right?
Yeah.
So our loans to funding ratio, we measure loans to funding ratio. I think for the year was it 89 or 90% ZK? Around about 89. Go ahead. Yeah.
It's around 90%, which is probably the best we have had over the last 3 years.
Yeah.
So from that perspective, we are comfortable.
Yes. But what we've also seen, so we don't have the typical debt equity in the way that, because if you look at it, our debt levels are very low, but we have been reducing senior debt as a component of total debt. We can probably share with you those details in need afterwards. We actually have a contingency line with Group that we've built over the years, as well as we have a line with Stand Chart, a contingency line with Stand Chart.
Sorry, if I may, just a follow-up question. I think I cannot live without talking about ROE. So well done. And I do not want to minimize the work and effort that went into improving efficiencies and to getting the ROE above cost of equity. But I just want to make sure that there is no strong correlation between where the repo rate is and ROE being above cost of equity. So the last experience was in 2019. Repo rate was also elevated. So is this year. So what happens when the repo rate falls? Will the ROE go down with it? Or has sort of things materially shifted such that we'll have a higher ROE for longer? Thank you.
Couple of variables I think one has to look at, and I'm sure ZK is burning to answer that question because he talks about it every day. So yes, so if you look at the denominator, which is really your asset base, your loan book, and what we're looking at, if you look at ROE, we're not comparing apples with apples when we look at industry ROEs because we're not reporting RAROC. We're not reporting return on risk-adjusted assets. We're reporting on average equity, I think, average equity, not year end. So we're not comparing apples with apples when we talk about equity. And on top of it, what are the drivers of equity? Yes, your profit, your bottom line, certainly, and that is impacted by your rate. But as ZK has mentioned, because of the lower demand for credit over the last financial year, our risk-weighted assets, they also didn't grow. And that freed up I suppose that lessened the need for capital. So that was a key. That is also a very key driver of. So it's also about your asset strategy. If you look at, for instance, our growth in residential mortgages over the last year, ZK also alluded to that. Residential mortgages consume less capital. So it's really looking at growing capital efficient assets as part of our strategy, as well as managing the return, which is profit, as well as managing. I suppose how we invest into capital light or no capital assets that consume no capital, such as your prudential assets. So it's really managing all of those variables and making sure that they remain in balance. So I think, yes, it's something we focus on. We'll continue to manage, but I can't say at face value when the rate cycle changes exactly how that would play out. But it's something that we position today to avoid in future. Excuse me.
There was a final question here.
Good morning, Lazarus Amokeshi, the Namibian. Just one quick question to you around Baratus dilution. Was that like a once-off, or if then Baratus performs a bit lower in the next or following financial years, then we'll see that there'll be a recovery in that investment?
Lazarus, thank you for that question. I actually forgot to mention it. So the significant growth in Paratus, I seriously hope that is not only for now. I hope that will continue in the future. But the dilution was a once-off thing that was included in the contract. So if we do dilute in future again, they will have to pay us market value for that. Plus a premium.
Okay. No, thank you, ladies and gentlemen. That brings us to the end of our formalities. Please note that you can also view and download our integrated annual report, our annual financial statements, and the social value report, the risk report, the governance report on our website. It's on capricorn.com.na. And yeah, for those who are joining us online, it's time to say goodbye and thank you for joining us.